Good afternoon and welcome to another Tax Tuesday. We are going to be talking about something we see every single year, investors and retirees making good financial decisions, but accidentally poor tax decisions. Investments can create tremendous amounts of wealth, but those same investments can be, the way they're taxed can cause dramatically different outcomes. So many people focus on returns, but they don't always focus on how the capital gains, the dividend, the retirement withdrawals show up on their tax return. So those are two very different things. Sometimes the issue isn't that someone did something wrong, it's that they didn't understand the tax rules, they didn't understand the timing or plan for it. Maybe they didn't understand how different types of income are taxed differently. So our goal for today isn't to turn you into a tax expert, it's to help you think more like a business owner and an investor, not just a tax filer. I'm Clark Boyd. Today with me is Kathy Stump, and we are Molen Associates. At Molen Associates, we've been helping taxpayers for over 45 years, educating them on what we strongly believe in, and that's that proactive planning prevents reactive problems. And we see so many reactive problems right now, especially yesterday with the tax deadline. Yesterday was March 15th, or March 16th this year. Anyone that's not aware, was the business filing deadline. We had a lot of people being very reactive and wanting to file on that deadline day. So there's only so much we can do when you're rushing like that. It's like we said, proactive planning prevents reactive problems. So hopefully by the end of today, you can understand how investment income like dividends and capital gains are actually taxed, how retirement income such as IRAs, 401ks show up on your tax return, where common reporting mistakes happen, and even how planning opportunities like Roth conversions, tax loss harvesting can improve your long-term results. So think of this as your investment playbook, understanding, planning, and optimization. Kind of the tagline I would say for today's webinar is successful investors focus on returns, but really smart investors focus on after-tax returns. So there's a big difference there. I just realized I wasn't keeping up with my slides. So we will start here. Kathy, do you want to kick us off on how different types of investment income is actually taxed?
Sure. This is the main categories of investment income. Capital gains. Capital gains result from sale of an asset. It's basically the appreciation of that asset for the period that you held it. It does have some preferential tax treatment as long as it's captured correctly. Dividends are returns, income returns from investments. They are also taxed differently than other types of income. There's qualified dividends, non-qualified dividends, and those are all both taxed differently. Interest income is another method of return of investment on your in your investments. It's just kind of a return based on an interest rate, and it just goes in with your other income. Retirement distributions are when you take periodic distributions out of a retirement plan, sometimes forced in the situation of RMDs, but you can also take withdrawals out of your retirement plans at other times, an emergency situation, something happens that you need extra funds for your home or your lifestyle. Just be aware that it is not a tax-free withdrawal in most cases because of that, and there can be penalties involved. Social Security income also plays into that in a lot of different ways. It's not taxable right out of the gate, but for most people, it is up to 85% taxable depending on your other income.
And so when we talk to a lot of investors or even retirees, they think, when we say, different income strategy or different investment income is taxed different ways, they don't think of capital gains, dividends, interest. They think, Roth or traditional. And that's one component of it. You want to be focused on Roth or traditional. But even deeper than that is these different categories. Each of them is taxed differently. For example, capital gains, you can have short-term capital gains, long-term capital gains. You could be at 0, 15, 20%. There's net investment taxes that can be tacked onto there. So there's so many different nuances when it comes to investment income. It's not just Roth or traditional. There is a lot here. So we're going to start with capital gains here, like I said. A little bit of it is just short-term or long-term capital gains. The biggest difference is how long are you holding this investment. If it's less than 1 year, it is a short-term capital gain, and that is taxed as ordinary income. That could be good, could be bad. Long-term capital gains, if you hold it for 1 year or longer, and that's where that 0, 15, or 20% income tax rate, depending on what your other sources of income are and how much investment there is. Net investment tax here, like we said, this is a 3.8% tax on capital gains, dividends, and interest income. So this applies, Kathy, correct me, but it's right around 350 for married filing joint. I don't know the exact number.
Yes.
Right around there, $350,000 in 2026 for married filing joint. If you're under that threshold, you're not subject to net investment tax, and that's total tax, not just capital gains, dividend, interest income. That's if your total income is over that 350 amount, the net investment tax applies to your investments. So even if 99% of your income is just normal W-2 income and you're over that threshold, even that small amount of your capital gains, dividends, or interest, that is subject to that 3.8%. So it's just basically a double taxation for those that are over that higher income.
That is a common misconception too, that it's only if your investment income goes over that threshold, but it's if your other income is over that threshold is when that kicks in.
Mm-hmm. Yep. The next section we'll dive into is dividends, and if you receive that form 1099 div. So this is basically a form that reports any dividends received during the year, but not all dividends are treated the same way. You've got qualified dividends, which are taxed at capital gains rate, and non-qualified dividends, which are taxed at ordinary income rates. So often the difference is how long you've held the investment. One of the biggest misconceptions we see is if, for example, a lot of Fidelity, Charles Schwab's, they've got these funds that will reinvest these dividends. That does not mean you avoid the taxes because you're reinvesting it. There's even plans called DRIPs, dividend reinvestment investment plans. So let's say you get a $10,000 dividend and you reinvest it. That does not mean that you don't pay taxes on that $10,000. You pay taxes in the year that dividends were issued. So it's not a tax avoidance strategy. It doesn't mean it's a bad thing for you financially. It could still be good to reinvest that money. A lot of people do that, but it is not an automatic tax deduction.
The other thing that happens with that, sometimes if you have dividend reinvestments, most of the larger funds do track that for you, but that's in addition to your basis. If you pay tax on that dividend, it counts as an addition to the amount that you put into the investment to start with. So if you are invested in another, just an individual stock or something like that, you need to make sure that you're tracking that so that when you do sell the investment, that you've kept up with all your basis.
The basis is really important for this next section, capital gains and losses, because a capital gains applies when you buy something for this value and you sell it for a higher value. Or if you sell it for a lower value, you could have a loss. So in this instance, let's say you have a $100,000 investment and you increase your basis, you buy more of it, let's call it another $500,000. You've got a lot of money in this investment and it continues to grow and grow and grow. You only pay taxes or capital gains tax on the growth. You don't pay it on the full amount. That's a pretty big misconception as well. They think, oh, I'm selling off $25,000 worth of this investment, but not all 25,000 of it is gain. Maybe half of it is gain and the other half was your initial investment. So you don't pay taxes on that basis. So that's one thing that's really important to track is your cost basis in any investment. That's basically the initial amount paid for the investment. If that number is incorrect, your gain or loss is going to be incorrect moving forward. So you really need to be paying attention to that. As Kathy mentioned, most brokerages they'll track this for you. They'll issue you a 1099 at the end of the year. They'll have your initial cost basis, what your growth has been, whether it's dividends, interest, capital gains. They break it down very cleanly for you. Another thing here to track is wash sales. So if you sell an investment at a loss and repurchase basically the same investment, whether it's identical or nearly identical within 30 days, the IRS disallows that loss. So this can be really, really big. Make sure you're not doing this. We have seen people literally lose thousands and thousands of dollars in taxes because you have to pay taxes on money you really didn't receive. You sold it at a loss and repurchased it. it's as if that sale never occurred. So literally, I've literally walked people out of the building and they're crying, and it's not a fun day because of these watch sales.
And the other important thing about bases is that even though they could be tracking it for you, it's always wise to kind of keep, keep your own kind of, just at least a gut check of how much you've put in, and include the, additions especially if you put in other money into it, so that you've kind of got a feeling for, because, 1099Bs can be incorrect. It's not often that they are, but it is worth just at least having your own internal record so that you can track at least a kind of a reasonableness check to see if it seems to be accurate.
Mm-hmm. Yeah. And most investors are buy and hold, especially in stocks and bonds, mutual funds, things like this. So usually your dividends, interests, capital gains are going to be fairly similar year over year. That makes it really easy if you happen to see, oh, why did it go up 5 times what it was last year? You might want to dig into it. You are the taxpayer. You need to be sure that you're not just taking their forms and reporting on it blindly, because they are wrong. And we see W-2s wrong all the time, 1099s. Just because your employer or this brokerage firm does things all day, every day, does not mean that they're perfect. There's still computer errors. So don't trust it blindly. Still do your own due diligence. One other note here on capital losses. So let's say you sold an investment and you lost $100,000. You normally cannot claim those losses of the $100,000. You can deduct up to $3,000 per year against your ordinary income, and that just carries forward basically indefinitely. So that can be really big if you have a huge capital loss, that you know how it's going to be treated.
That's another common misconception that people have about that. Is it's like, oh, I lost so much money on this, I'll get to write all that off on my taxes. And you do, but it's not, you can't write it off in that year unless you have other capital gains.
Mm-hmm. So Kathy, question on this. Let's say I had a $500,000 loss this year, and next year I have a $500,000 gain. How would that apply?
You can, as long as it's another capital gain. If you have a $500,000 capital gain and you have a $500,000 wash carryover or a loss carryover, then you would be able to deduct that against that capital gain. Just have to make sure that you're tracking everything and that you're reporting it as capital gains and losses, so that they line up and the IRS is not wondering what you've done on your tax return.
Perfect. So capital gains, I guess up to this point, we've talked mainly about reporting, and now we're going to shift a little bit more into the planning side of things. So many investors assume that taxes just happen automatically. That is not the case. You often have control over when your gains are realized. So not always. If you're just in mutual funds, sometimes they buy and sell for you, and you just take the 1099 at the end of the year, you file. But if you're more active in selling and buying, you can control when you, for example, harvest your investment losses. If you want to spread your gains over multiple years, or take it all in 1 year. So there is a 0% capital gains bracket. If that applies, you want to make sure you can maximize that. Maybe your other income, maybe you have a high income year, you don't want to sell off more investment income. Maybe you save it to a lower year so you can spread out your tax liability year over year. So there's a lot of planning opportunities just knowing your overall tax situation year over year. You don't want to throw a ton of taxable sales in 1 year if you can spread that out over 2 or 3.
That's another planning idea too, that you always make sure that you're kind of looking at that. We always say that once December 31st hits and you move into January the 1st, that a lot of those planning opportunities go away. So you do have to really know what your taxable income is going to be. Projections are very important in this situation, so that, especially if it's an unexpected transaction, that something happened and you might have some more income than you anticipated. And if you do have a stock that's sitting there with a built-in capital loss, and you're not thinking that you want to hold on to it, it's just kind of just not performing well, now might be a perfect opportunity to get rid of it and offset your higher income year.
So like Kathy said, these projections are super, super important, not just from a tax preparation standpoint, but also with your investment side. If you have a financial planner, we highly recommend meeting with them. at least once a year, ideally once a quarter, so you can see what your, not only your W-2 and your main active income sources are, but how will this more passive income, your investment income, how will it be performing? Kind of going to this next slide here for capital gain, or for, there we go, for Roth conversions. When should you be doing a Roth conversion? You may have, let's call it $500,000 in a traditional IRA account or a 401k, and you're 62 years old. Well, how much do you want to do now versus how much do you want to wait? So there's IRMA to worry about. There's when are you going to retire? When do you need to take Medicare? There's all these different decisions, and it's usually not just a one-time decision. It's, you want to be planning 5 to 10 years out, especially the more substantial that account balance is. The further in advance you can plan for these Roth conversions, the better, because you can say, hey, you know what, this is a high year. Maybe I'm going to minimize the number of Roth conversions. Next year is going to be a lower income year. Let me do more this year. And over the course of, let's call it 8 years before your 10-year retirement, you can have 90% of this taken out. That minimizes how much hand the government has in your 401k, because they're going to dictate what your taxes will be long term. If you want to minimize that impact, you can pay the taxes now, lock it in a lower rate. You at least have more control over your long-term outcomes. So a few notes here on 401ks. Basically, the difference between a traditional IRA or traditional 401k and a Roth account. Traditional IRA, you get the tax deduction when you put the money in. Roth, you pay the money, you pay the taxes up front, and it grows tax-free. So do you want the tax deduction now or tax deduction really later? It's kind of the way you can look at it. A lot of tax strategists believe that tax brackets now are the lowest they're going to be. We can only see them increasing. No one has a crystal ball, so can't guarantee anything. It really is, what do you think the tax brackets are going to be? But if your income is going to be higher in retirement, you might be better off taking a Roth contribution now over a traditional IRA. Or if you think your income is going to be lower later, yeah, take the tax hit or take the tax deduction now with the traditional IRA or 401k, and then pay the taxes later when your income is at a lower rate. So that's really the strategy between Roth and traditional, but you can do both. You don't have to do completely one or the other. One thing to be aware of right now, especially if you're in that, let's call it 55 to 65 year old range, now is the time to start planning for those Roth conversions. It's not 63, because by 63, you're now 2 years out before that Medicare age limit hits, and they have a 2-year look back for the IRMA. So if your Medicare premiums are going to be higher and you did Roth conversions in those 2 years, you just now increased your premiums even more because your income went up. And you can say, oh, well, that was 2 years ago. There's a 2-year look back. So you need to be doing at least 2 years before that, and be really, really conscious of what you're doing to make sure you stay below that IRMA threshold 2 years before 65. Also, if you're over 65, you can continue doing Roth conversions. Still pay attention to the IRMA. That 2-year look back continues all the way through retirement. But the one big beautiful bill, now if you're 65 or older, there's a $6,000 senior tax deduction from 2025 through 2028. So if you bump your income up because of these Roth conversions, you could lose the $6,000 deduction. So Roth conversions are not just a silo. There's a lot of different strategies that come into play. There's also the SALT cap, the SALT tax deduction. It used to be $10,000, now it's $40,000. If you convert too much, you may go from $40,000 itemized deductions down to 10, just by nature of what your adjusted gross income is. So make sure you have all of these things into play. And with that being said, today is not meant to be comprehensive. It's really just to show there's a lot of planning opportunities. If you want to save on taxes, we highly, highly recommend working with a tax planner, because it can make a difference. We're not just talking a few dollars here and there. For some people, this is tens of thousands of dollars. So it can be very, very impactful. Kathy, anything else to add on Roth conversions? I know I went off quite a bit there.
No, I think that's it.
Awesome. Retirement account withdrawals. So when you reach retirement, distributions from the retirement accounts they're usually considered taxable income, assuming it is a traditional IRA, 401k, a pension, and this is taxed as ordinary. It can be taxed as ordinary income. So if you're before that age, there's early withdrawal penalties, and that early withdrawal is generally before 59.5. It's a 10% penalty on top of the tax. If you wait till, depends on your age, but 72, 73, on these accounts, you'll be required to take an RMD, a required minimum distribution. And I think we get into that in a little bit. So I won't go too deep into that. But make sure you're taking the appropriate amount out of your 401k to satisfy the RMD, but also don't do it too early. Unless you're planning on that 10% penalty and paying the taxes, usually your retirement account is not the best way to take out funds unless you are really in an emergency and you don't have access to a loan or anything else. Don't take it from your retirement account. It is not a financially good move.
Sounds like you worked really hard to contribute to the retirement account and build that up for your retirement. That's why it's called a retirement account. And if you take money out ahead of time, the 10% penalty can eat into it really quickly. And the other thing too is, like, people kind of have the misconception that they're going to be in a lower tax bracket just because they're retired. And that's becoming increasingly not the case for a lot of people, that you're still in the same income tax bracket or maybe even higher to retire. And you're not going to be able to just say that, okay, let's tax less, because in many cases it's taxed the same, or even in some cases more.
Mm-hmm. Yeah. I had something I was going to add there, but it just spaced it. So moving on to RMDs. Here's what it is. So for that 10% penalty, that only applies for traditional IRA or traditional 401ks, because you've gotten the tax deduction. It is a retirement account. It's sitting there. You cannot touch it till 59 and a half. Or you pay the taxes because you got the tax deduction and a 10% withdrawal penalty. Basically, they're saying, here's your slap on the wrist because you're not following the rules. A Roth 401k or a Roth IRA is a little bit different. You can take back out your basis. So that initial investment, you can take that out without a penalty. So you can't touch the investment income because that's the growth. That is still your retirement account. So if you want a little bit more flexibility, you think, hey, I want to contribute to my retirement accounts, but I don't want to be penalized. Maybe Roth is a little bit more flexible option for you. So that could be something to keep in mind. So required minimum distributions, as we mentioned, these are basically it is a portion of your traditional IRA or traditional 401k that you're required to take out each year. So based on your age and the balance on the account, there will be a set number that you have to calculate every single year. So work with your financial planner to make sure you know what that amount is, because if you don't do it, you're talking huge penalties. So just like those early withdrawal penalties, you got a 25% early penalty for not taking an RMD on top of the taxes. So you might as well take the funds and do something with it. It's just better to pay the taxes and be done with it rather than paying taxes on money you won't see. So not fun there. A planning opportunity or qualified charitable distributions, QCDs. So you're required to take these funds out. If you don't want them to be considered taxable income, you can take it from your investment account, take your QCD, take your RMD, put it into a QCD, and now you have the ability to donate that to a charity of your choice. So it's a way to offset that income. If you want to keep your income a little bit lower for whatever reason, you can donate that money to the charity of your choosing, and it still satisfies that RMD requirement. And I believe QCDs, you're limited to $100,000 per year. Is that correct?
That is correct.
Okay. So it's not all company. You can't do $2 million into a QCD. You are limited to $100,000 per year. But for most taxpayers, if you're looking to do some tax planning, for example, if you want to stay below that $6,000 senior deduction or take advantage of the SALT cap, this could be a good way to say, hey, I need to get my income down $25,000 and I get these 2 credits. Okay, do a QCD, bring it down below that threshold. You now reactivate some of the benefits in the tax code, and you can donate whenever you want. So it's all about timing, record keeping, and just knowing what's out there. So it can be a huge, powerful strategy or if you want to donate to a charity. Another one here, Social Security taxation. So there's not a lot of tax strategy that comes into play when it comes to Social Security taxation. Generally, Kathy, what did you say? Over $45,000 of income?
44,000.
It becomes taxable. So hopefully your income is above $44,000 in retirement. Hopefully you're paying taxes on your Social Security. Not that we want to pay double taxes, but it means that your income is higher. So it just is what it is. There could be some strategy if you work with your financial planner to figure out when you should be taking your Social Security, especially if you're married, filing joint. Maybe you want to take yours now and your spouse can wait till 72 just to maximize benefits. So maximizing benefits, there is some strategy there, but from a tax standpoint, there's not a whole lot here. It's just either taxable or it's not. And that $45,000 roughly, and that includes your investment income, retirement distributions, your W-2, interest, it's everything. So
that is a common misconception. People think that just because their Social Security is not more than the $44,000 that, it's not taxable, but that's not the case. You have your other income that's that, and also add back tax exempt interest. So there are some pretty strict rules on how you calculate that Social Security taxation.
Mm-hmm. So good to know. This is truly one of those things that is double taxation, because you pay taxes to get Social Security and then you pay taxes again on the Social Security. So it's not ideal, but it is better to have it and pay taxes than not have it. Mm-hmm. Documentation. So as we've talked about, we've had a few different webinars in the past, and they always come back to documentation and planning, and that's because it really does matter. The devil's in the details. Your investment sources will often provide your 1099. We see the dividends, the B, interest, 1099-R. Those will be produced by those different firms or brokerages, whoever you rely on. But it's also good to track how much you contributed to either a Roth IRA or a traditional IRA. What is your cost basis in these investments? Your IRA contributions, you got Form 8606. The Roth contributions are, was that 45, 85, something like that?
45, 85.
So those usually don't come out till May for some reason. Mm-hmm. But it's good for you to have those records in case there is an issue with the reporting, and just be a good steward of your money. Make sure you're handling it correctly. Kathy, anything else to add before we move on to question and answer?
I don't think so.
Okay. So for the last couple minutes we have here, feel free to put any of your questions, and this could be capital gains, it could be investment, retirement income related, it could be anything else. We're right in the middle of tax season, so if you have any questions, feel free to add them to the chat, and we will answer a couple of them right here. Okay, so first question, is a Roth conversion always a good idea?
Not always. Every person's tax situation is different, and it's very important that you make sure that everything is together when you're making planning. Don't just decide, okay, well, if I do this, I'll save X. It might be different based on what other kinds of income and what other kind of tax situation you're in at the time. So it's really, really important to make sure that you get a good starting number, and that way you'll know that, okay, my income before the Roth conversion was this. If I do the Roth conversion, this is what could happen. And just make sure that you're always thinking about that. It requires paying taxes on that money that you're taking out, and that's what a lot of people don't realize. You get a deduction if you've got funds in those other accounts. It was put in there tax-free. Basically, it was before tax on your W-2, or it was a deduction on your tax return. So there's not ever been any income tax paid on that. So when you do convert it, it's fully taxable at ordinary income rates. So you just have to be prepared for that. And knowing then also that to be able to take it out tax-free on the earnings, you have to keep it in there for 5 years. So it's a good strategy, but just make sure you consider all the options and all the things that go into play with it.
Perfect. Next question. How do capital gains affect my tax bracket?
Well, capital gains are income. So basically, it's another one of those things where you put kind of everything together and you get to at your bottom line, what taxable income that you're in. It's taxed at different rates, different capital gains and different qualified versus non-qualified dividends. They're all taxed at different rates. But when it comes to gross income and adjusted gross income, they factor into that. So it can bump you into a higher bracket because the Internal Revenue Service brackets are graduated. So if you're right at the cusp of a bracket, going into the next bracket can cause a pretty significant tax burden.
Perfect. One last question here. How can I reduce my taxes on investment income in retirement?
Well, it's basically what we talked about a little bit before, that a common misconception being that your brackets are going to be lower, and they're not always. But you can do the same sort of things that you would do normally. Tax loss harvesting, if you know you're getting ready to retire and your income's a little bit higher than you thought it was going to be. If you've got some investments that are just not performing well, that's a good opportunity to reduce those and get rid of them. Sorry.
Tax season.
Yeah, everyone wants something right now. Managing that timing of capital gains is really super important. If you've got, if you know down, like, okay, this year's kind of bad, I'm going to go ahead and pay my taxes because I know next year's going to be worse. It's all about timing, just making sure that you're considering all the facts of your circumstances, both now and the next few years, to make sure that you're taking, just taking advantage of the lower brackets in the years that it's available, and being prepared in the years that it's not.
Yeah, so you got Roth conversions, harvesting losses, managing timing of gains. We talked about donor advised funds, qualified charitable qualified charitable distributions. Even so, many people think of a financial planner as helping them amass this amount of wealth, but the second part is this spend down phase. A financial planner can be really helpful in knowing what to sell and what to spend to maximize your input, or whatever you put into the investments. You want to make sure it lasts as long as possible as well. So some of that is a tax standpoint, but there's different investment vehicles that can be treated differently. So work with a financial planner, and that can also help reduce taxes, but not just the taxes in itself, but the long-term effects of your income. So that's all we've got time for today. So thank you guys for joining us for this week's Tax Tuesday. We hope this gave you some clarity around how investment income and retirement distributions are actually taxed, and how planning ahead can significantly improve your long-term results. So the goal isn't to just learn more, but it's to keep more. And thank you for joining us.
Thank you. Have a nice day.